It feels like everywhere you turn lately, there's talk about market swings, economic uncertainty. It's a lot.
It really is. And it can make investing feel, well, pretty stressful for a lot of folks, like trying to steer a ship in a storm.
Totally. But, what if there was a kind of compass, a reliable way to think about all this, despite the noise?
Well, there arguably is, and it often comes back to the wisdom of Warren Buffett, the Oracle of Omaha, right?
Right.
He has that famous saying, be greedy when others are fearful, and fearful when others are greedy.
Yeah, I've heard that one.
And it's more than just a catchy phrase,
Yeah,
it's really like a core principle for thinking about investing long term.
exactly. So today, our deep dive isn't just about unpacking that quote itself. We want to really get into the foundations of the whole philosophy behind it.
Okay.
The goal is to give you, the listener, a sort of practical toolkit based on Buffett's ideas.
Mm-hmm.
How can you actually use this stuff in your own investing?
Sounds good. So where do we start? The absolute bedrock, I guess.
Yeah, let's start with value investing. That's really the foundation.
Okay, so what's the big idea there? Value investing.
Okay, so think about it like this. Try to forget the flashing stock prices for just a second. Imagine you're buying a piece of an actual real business, not just a symbol on a screen.
Right, you own a part of something.
Yeah, like buying a house.
Yeah.
You wouldn't just pay whatever the seller asks without looking around.
Right.
You check the foundations, the roof, the neighborhood. You try to figure out what it's really worth.
It's intrinsic value.
Exactly. Intrinsic value. That's the term.
And for a company, that intrinsic value is what the business is genuinely worth based on, its assets, how much it earns, its future potential, all that stuff.
Mm-hmm.
And Buffett's whole game, essentially, is finding companies where the stock price, what the market's asking, is way below that real underlying value.
He's looking for a bargain, basically.
Pretty much. He famously talks about wanting to buy a dollar bill for 50 cents. Find that gap between price and value.
Makes sense, like finding a great deal. And part of finding that deal, that lasting value, is looking for what he calls a moat, right?
Yeah, the moat. And we're not talking castles here.
Oh, right.
In business terms, a moat is some kind of sustainable competitive advantage, something that protects the company's profits from competitors just rushing in.
So what kind of things act as a moat?
It could be a really strong brand name that people trust, like, say, Apple or Coke, or maybe unique technology, patents. Maybe they just have way lower costs than anyone else.
Okay, so it shields the business long term.
Exactly.
Yeah.
It helps ensure they can keep making money over time.
And I think it's crucial to stress this isn't about getting rich overnight.
Oh, definitely not.
Value investing, Buffett style, is it's a long game. You need patience. You're owning pieces of businesses, letting them grow, like planting seeds, really.
Yeah, that's a good way to put it. Which kind of leads perfectly into another big principle of his.
Which is?
Never invest in a business you cannot understand.
Ah, yes. Sounds simple, but it's pretty profound when you think about how he applies it.
Totally. Remember the dot-com bubble back in the late 90s, early 2000s?
Oh, yeah. Chaos.
So many tech companies with really complicated, hard-to-grasp business models. And Buffett, well, he largely stayed away.
Which looked maybe a bit old-fashioned at the time, I bet.
Maybe. But he stuck to his guns. He invested in what he understood. And we know how a lot of those dot-coms ended up. It wasn't about being anti-tech. It was about sticking within his circle of competence, as he calls it.
Right. It's actually a strength, isn't it? Being honest about what you don't know.
Absolutely. It's intellectual honesty. He focuses on businesses that are maybe simpler to understand. Think about consumer goods, insurance, banking, utilities.
Yeah, stuff people use every day. Pretty much.
Right. Maybe not the flashiest industries, but you can generally figure out how they make money, what their risks are. They often have predictable earnings.
Like Coca-Cola, which you mentioned. It's a classic Buffett example, isn't it?
It really is. Simple product. Everyone knows it. Global brand, built over, what, a century?
Mm-hmm.
And people keep drinking it. It's a consistent demand. He understood the enduring nature of that business. It wasn't some fleeting trend.
He could see the long-term picture.
Exactly. And, to really see how deep this understanding the business thing goes for him, there's that amazing story about American Express.
Oh, the salad oil scandal? That's a wild one.
Isn't it? Back in the 60s, basically, Amex got tangled up in this huge fraud involving, vats of supposedly valuable salad oil that didn't really exist.
Yikes. Bet the stock took a nosedive.
Oh, it plummeted. Massive fear in the market. Everyone was dumping Amex stock.
So what did Buffett do? Run for the hills?
Nope. He did his homework. He actually went out, visited their offices, talked to restaurants, merchants, tried to gauge if people were still using the Amex card.
She was like a detective.
Kind of.
Yeah.
He famously even thought about, how essential the card was. Like, were people still buying sandwiches with it? Did the scandal change the fundamental way people used Amex?
Uh-huh. The sandwich test. Love it. But his point was serious.
Totally serious. He concluded that the underlying business, the brand trust, the customer loyalty, the network, was still incredibly strong, despite this massive, embarrassing hit.
So while everyone else was panicking,
He saw an opportunity. He understood the real value beneath the surface noise. So he bought a lot of Amex stock very cheaply.
and it paid off, obviously.
Big time. It's just a fantastic example of having conviction because you truly understand the business, allowing you to act against the herd.
And that understanding isn't just about the business model, is it? It's also about who's running the show.
Oh, absolutely critical for him. Management quality. He
Wow.
looks for leaders who are competent, rational, and really importantly, ethical.
People you can trust with your investment.
Yeah. People who think like owners, not just hired hands. Are they focused on the long-term health of the company? Do they use shareholder money wisely, maybe reinvesting it smartly or paying dividends? Integrity matters a huge amount.
Okay, so we've got find good businesses you understand, buy them at a discount, make sure they're run by good people. What else is in the mix?
Well, there's this other piece, maybe less exciting to talk about sometimes, but utterly essential to how wealth gets built over time.
Let me guess. Compounding.
You got it. The magic of compounding. Einstein supposedly called it the eighth wonder of the world.
High praise. So, break it down simply. What is compounding?
Okay. Basically, it's earning returns not just on your original money, your initial investment,
Right.
but also earning returns on the returns you've already made. So
Right.
your money starts making money, and then that money starts making more money.
It builds on itself.
Exactly. Think of that snowball rolling downhill.
Yeah, I like that analogy.
It starts small, but picks up more snow, gets bigger and bigger, faster and faster. That's compounding with your investments over a long period. It's exponential growth.
And the key ingredient there is
Time. Simple as that. Time is the fuel for compounding. Look at Buffett himself. He started young, sure, but the vast, vast majority of his wealth was actually generated much later in his life.
decades later.
Decades! Because that's when the compounding effect really kicks into high gear. It just shows you need that long runway.
It really hammers home that investing his way is a marathon, not a sprint. It holds on to companies for ages, doesn't he?
For years, often decades. He lets time do the heavy lifting, lets that compounding work its magic. He's not worried about what the stock does next week or next month.
So just to make it concrete for people listening, say you invest, I don't know, $100 a month,
Okay.
starting at age 25 until you're 65. And let's say you get an average return of like 8% a year.
Over 40 years.
That $100 a month, thanks to compounding, ends up being, well, a lot more than just the sum of all those $100 deposits. Right?
Oh, significantly more. Dramatically more. The returns start generating their own returns. And over 40 years, that effect is massive. It shows how even small, consistent amounts can grow into something really substantial.
Which is pretty motivating, actually. It means you don't need a huge lump sum to start.
Not at all. Consistency and time are the secrets. Start early if you can, but starting now is always better than waiting.
Okay, so this brings us back kind of full circle to that famous quote about fear and greed. Because understanding value in compounding is one thing, but actually acting on it, that takes discipline.
Right. Huge discipline. That quote, be greedy when others are fearful, fearful when others are greedy. It sounds simple, but living it requires real emotional control, resisting the urge to follow the crowd.
Yeah, and Benjamin Graham, Buffett's mentor, had that great analogy for the market, didn't he?
Yeah.
Mr. Market.
Ah, yes, Mr. Market. It's such a brilliant way to think about it.
So explain Mr. Market.
Okay, imagine you co-own a business with this guy, Mr. Market, and he's, let's say, a bit manic depressive.
Okay.
Every single day, he shows up and offers to either buy your share of the business or sell you his share. No obligation either way. But here's the thing. His prices are all over the place. Some days he's euphoric, wildly optimistic, and offers you a ridiculously high price.
Tempting to sell then, maybe.
And other days, he's utterly miserable, panicked, and offers to sell you his share for peanuts, way below what the business is actually worth.
So what's the lesson?
The lesson is, you don't have to listen to him. Mr. Market is there to serve you, not to guide you.
Hmm.
His moods, his crazy prices shouldn't dictate your actions if you know the real value of the business.
So when he's fearful and prices are low,
That's your potential opportunity to be greedy, to buy good assets cheaply.
and when he's overly excited, euphoric, and prices are sky high.
That's when you should be cautious, be fearful perhaps, or
Yeah.
at least not get swept up in the buying frenzy. You use his moods to your advantage rather than letting them control you.
It really highlights how market downturns, when everyone's scared, can actually be the best times to invest long term.
Absolutely. Because fear doesn't always discriminate. It can pull down the prices of great companies right along with the weaker ones. If you've done your homework and have the discipline, those are the moments you look for.
But it's so hard. Most people tend to do the opposite, right? Buy high when things feel good, sell low when things get scary.
That's the herd mentality. And Buffett's entire approach is often about zigging when the crowd zags, based on rational analysis, not emotion.
So much of this comes down to psychology then, controlling your own emotions.
A huge part of it. Buffett's genius isn't just analysis, it's his temperament. His ability to stay detached, rational, and see volatility not as risk, but as opportunity.
Okay, this has been fantastic for understanding the philosophy, but let's get really practical. How can someone listening right now start applying these ideas? What are the actionable steps?
Great question. Okay, first, educate yourself. Commit to understanding the businesses you own or are thinking of owning. Don't feel pressured to invest in stuff that feels too complex. It's okay to say, I don't get this.
Stick to your circle of competence.
Exactly. Second, focus on value, not just price. Look for quality companies trading at what seems like a discount to their real worth. Don't just chase momentum.
Third,
Think long-term. Really embrace that compounding idea. Be patient. Resist tinkering with your portfolio all the time based on news headlines. Years and decades, remember.
okay, and the big one.
Discipline.
Yes.
Yeah.
Develop that emotional control. Make a plan based on value and your goals and try your best to stick with it, especially when the market gets choppy. Don't let fear or greed drive the bus.
See downturns as potential sales, not just disasters.
Right. Reframe volatility. And finally, just start. Even small amounts invested consistently over time can make a huge difference thanks to compounding. Don't wait for the perfect moment.
And you mentioned index funds, too.
Yeah, Buffett himself often recommends low-cost index funds for people who don't have the time, skill, or maybe just the inclination to analyze individual companies. It's a great way to own a piece of the whole market and benefit from its long-term growth without needing to be an expert stock picker. So it boils down to own good businesses, understand them, be patient, stay rational, and keep the long view.
That's a pretty good summary. It's about being an owner, not a speculator.
Look, the market's always going to fluctuate. There will be good times and scary times. That's just how it works.
It's inevitable.
But hopefully, understanding these principles from Buffett gives you a solid framework, a kind of anchor to navigate it all more confidently.
Definitely. It provides a rational approach amidst the noise.
So maybe a final thought for everyone listening. Thinking about everything we've discussed, value, understanding business, time, discipline. What was maybe one key takeaway from Buffett's way of thinking that really clicks with you right now? Something to maybe chew on.
That's a good question to ponder.
Take that thought with you, because having this knowledge and combining it with patience and discipline really can be your most valuable asset in the long run.